Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us, speaking of, is George Ferguson. He's Senior Aerospace, Defense, and Airlines Analyst at Bloomberg Intelligence, and he joins us from Princeton, New York, our BI headquarters over there.
Princeton, New Jersey.
In New Jersey. What did I say?
Princeton, New York.
I did?
Yeah.
Sorry.
Coffee.
I haven't had that second cup because it was delayed. I'll get you. The 11 o'clock hour will be a good hour for me. So Boeing is having a lot of issues. The CEO will be facing leaders in Congress today. There was also latest whistleblower report that alleged that the plane maker mishandled and lost track of hundreds of faulty parts, some of which may have been installed in some new 737 MAX planes. George, there's so many questions, but what is Dave Calhoun today going to face from Congress, and then in the light of these consistent whistleblower claims?
So my guess is that what Dave Calhoun is going to say today, he's going to stick to the script. He's going to say they're working on fixing all these problems. He'll probably, not be able to confirm or deny sort of individual reports. We saw the report come out, that Boeing, they gave us a summary of what they provided to the FAA on their action plan, for improving the production process. It included things like, making sure they appropriately tracked faulty parts and didn't put them in airplanes. So my guess is there were some situations where this was a problem. But again, I think he's not going to give a lot of specifics today in front of Congress. I think it's he'll stick to the script, and there's a plan out to fix it, and he'll say we got the plan, and we're going to drive on that plan.
Hey, George, I know from speaking to you in the past and reading some of your research, one of the challenges as it relates to quality is outsourcing. Boeing over the last number of years, 10, 20 years, has maybe outsourced a little bit more of their production, their parts, and so on to third parties, and that may be introducing some more risk into their process. How are they talking about some of their outsourcing strategies?
So in that same report, right, they talk about inspections at suppliers. They talk about monitoring quality at suppliers better. Yeah, I just think this is it's a wholly different industry, right? I think there's a bunch of people that have come to the aerospace world from auto backgrounds and other mass production backgrounds, right? And in those worlds, safety isn't as important. Volume is a lot higher. You can get multiple suppliers to provide products to your production line. You can work cost on those suppliers. And I think that whole game plan is really, really difficult to do in aviation. And I think this is part of what we're seeing, right? I think you can outsource, but I think if you outsource, to your supplier base, I think it's still got to be a pretty strong relationship with them, not a combative relationship where it's always about price, because it really matters the quality you get to your line, right? Safety is dependent upon it. And so I think what we're finding out as this sort of whole Boeing saga unravels is outsourcing and banging up your suppliers for price just isn't a winning strategy in aviation.
Have they course corrected enough, or can they?
So look, I think they can. Everything can be fixed. I think if you look at their competitors across the pond, Airbus, they're not having these problems. I think Airbus has been less competitive with some of their suppliers. They're in the middle of this correction. We know they want to buy Spirit AeroSystems. We're still waiting to hear news on that. There's still, the challenge of getting some of the other companies that Spirit supplies to, namely Airbus, probably out of the portfolio. So they can recover. It's going to take some time, and it's going to take a lot of work with their suppliers.
So, George, if I think about rethinking my strategy with my suppliers and maybe focusing less on price competitive, maybe a little bit more on quality, does that imply that Boeing's profit margins will be under pressure going forward?
Yeah, I mean, I think for sure, right? I think you're not going to see a return to the Boeing margins you saw at the end of last decade. I'm not going to say ever. Like in time, perhaps they could get back to that. But I think it takes, it's going to take a bunch of work here near term to improve the quality, and that's going to cost money. Plus, we already know that some of the business they put in the books, right? They had some challenges delivering into China. That was kind of the 1-2 whammy after they had the grounding of the MAX and the crashes. We know they probably sold a bunch of airplanes for some pretty good prices to really core customers like United, like Southwest. So I think both on the cost side, again, given this correction to improve the supply base, improve production, get capacity rolling again, as well as some of the pricing they gave away on backfill for orders, means you're not looking at a Boeing that's going to get those margins for you through this decade, I think.
If I look at Boeing stock then, I mean, it's down from December. It's down 34%. Does that accurately reflect then this tighter profit margin world, the sort of revamp and the course correcting that they have to do?
So, I think when you look at their valuations, their historical valuations, one, they're really high right now, right, because earnings are so low. So I think that there is a little bit of investor look through at this point, on the current problems they have, but the sort of whether or not they're properly positioned for the out years right now, I think it's all a function of if they can quickly improve the build rate so they can improve economies of scale and start to get more profitability back into this business, and that really remains to be seen.
George, you mentioned China. Where is Boeing in terms of getting the 737 MAX in the air in China? Kind of how's that business looking in terms of sales and deliveries?
So their deliveries going into China, right? And it looks to us to largely be deliveries that were, built, when the 737 was grounded, and they're starting to get some of those back into the country. But China's also has this problem now with the flight recorder that's been, authorized by other jurisdictions, including the U.S. So, I mean, it feels to me like China's allowing deliveries, but they still, they're still not, I don't know, maybe keen on taking a lot of deliveries from Boeing. I haven't seen a bunch of orders come in from China, for Boeing. And so I would say that relationship still, while it's maybe thawing a bit, is nowhere near was it where it was in the last decade. And they have their problems too right now. I think they don't need as many airplanes. Their economy isn't growing as fast. Air travel isn't growing as fast. But I still think that relationship is not in the right place where it should be, where you'd like it to be, I think, for Boeing.
Before I let you go, any word yet on a replacement for Dave Calhoun? Like, how's that going? He laughs. His answer is laughing.
Yes.
What I hear from news reports is it's picking up steam, but I mean, I don't know, it's been a while. There's a lot of conjecture. It's a hard job. There's probably a lot of people that just aren't willing to take it. I don't know, they got to the end of the year, and so maybe they're going to use it all. I don't know.
I mean, and anyone but Larry Culp that you keep hearing about that's for real?
So I don't really track the people. That's kind of hard for me.
Okay.
I do know, like it said, there's got to be a rock star manufacturing, sort of CEO. I don't know that there's a lot of them left in America. I think we do a lot of outsourcing now, so
Yikes.
Maybe that makes it a taller order too. I don't know.
All right. Hey, George, I really appreciate it. George Ferguson, Bloomberg Intelligence, Senior Aerospace, Defense, and Airlines Analyst, joining us from Princeton, New Jersey.
Yes.
Who would have thunk?
Yeah.
It was in New Jersey and not New York.
Lovely.
Just kidding.
Home of Hoagie Haven, my favorite sandwich shop on
Just
the
still
planet.
waking up on that.
Yeah. Boeing
but-
down 2%
yeah.
today, down 33% year to date. It just feels like a stock. No one wants to step in and really take a big position here until you see real signs of a turnaround. Because it just feels like every day there's something coming out.
And if you just time it out, right? Like, say they do take the rest of the year to get a new CEO. Like,
Yep.
let's just game that out for a second. Then the new CEO has to come in, right? Then it's a plan.
Yep.
And it's going to be some kind of restructuring plan in that, like, how we're going to manage the business, how
Yep.
we're dealing with suppliers. And then if they do wind up buying Spirit Aerospace, then you got to integrate that. I mean, how long of a process is that?
Yep, exactly. So, I mean, and is there a value here where it just says, I'm being compensated for that risk and that time? And I don't know, and it just doesn't feel like it. Again, stock down 33% year to date.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, coming up, we're going to talk to Jill Blanchard. She is president of Enterprise Client Solutions at Advantage Solutions, and we're going to get the take here on retail sales. So retail sales barely did anything, and the narrative here is that the consumer is strained, that they're going to buy stuff, but they're going to buy it on sale. The rub here is that this is mostly a goods report versus what we're going to get when we get consumer spending a little later in the month, where that might be actually a services reports. There's still questions as to what the real read-through is for the consumer. Jill, what are your thoughts?
Yes. So hello, and thanks for having me back. Yeah. I think I'd lead off with one big word, and that word is cumulative. And so the effect of inflation, the slow rise in income, the high interest rates are really having finally a cumulative effect on the consumer. And it's a really big impact. There's a big difference between inflation and affordability, as well as inflation and high prices. And so as consumers try to get used to high prices, if wages aren't keeping pace, and they're not, it creates a pretty big gap and drives very different behavior. So you mentioned promotions before. Consumers are really doing a lot of different things. They're still spending, but they are price conscious, they're creative, they're selective. They are, and I'm just going to walk through like a myriad of strategies. They're delaying purchases. They're trading down, whether that's a brand or a retailer or a product or experience. They're shopping promotions. They're price shopping across retailers. So instead of that consolidated trip, they're going to multiple retailers. They are cutting out or reducing discretionary spending. They're looking for larger size products that have a more economical value. They are sharing bulk grocery shopping. A third of consumers are now doing that. A quarter of consumers are skipping meals and buying unhealthier options because of high prices. So it's a lot of different strategies that we're seeing come to play.
I don't know if we have any data to back this up, or when do consumers get used to this new price level? Is it because it seems like we've been here for a few years, and when do we get used to it?
Yeah, that's interesting. So I'd say it's a tale of two economies right now. And so at the macro level, we're seeing it flatten out. But when you really get underneath that, healthier income households, do have a healthy spend. They're driving demand, but it's balanced out by low and mid income households that are curbing their spending. Now that split spending, that's a shift from what we've seen over the past couple of years, because spending was really fueled by pandemic era benefits, stockpile savings, the cessation of student loan repayments, a rapid wage increase. And so a number of things that are either reduced or actually eliminated now, creating a bifurcation in spending amongst income households.
Mm-hmm. When we take a look at the spending problem, how do we understand it? Because slowing versus falling off a cliff are different, and they're going to have different reaction functions for the Fed. What's the best kind of description?
Slow. I mean, nothing's going to happen fast, right? I'd say there's two things to consider. One is spending is never going to take a sharp turn in either direction. It's going to slowly turn in either direction. And there are multiple factors influencing that, like the reduction in the pandemic era benefits and stockpile savings, as well as, higher prices, as well as lower wage increases right now, interest rates. So there's so many things that really affect it. I think that we can, continue to expect to see things happen slowly over time, and not be surprised by what it is that we're seeing today. It's been building to this for many, many months.
Cicadas.
Oh, what?
Talk to us about cicadas.
I will talk to you about cicadas. So here's something interesting, and this is, partly about cicadas, and I happen to live in a cicada part of the country. It's brutal out there.
Is it really?
It's like The Shining. So here's the thing. We've talked about inflation. We've talked about the slow rise in income, the high interest rates. Let's talk about the effect on retail spending of extreme weather, which I know we've talked about before. We saw today that there's going to be record-breaking temperatures in the Midwest and the Northeast. So it's extreme heat, it's flooding, it's fires, it's hurricanes, snowstorms, tornadoes. All of those things curb outside of the home activities, which are typically associated with bigger ticket spending. So think of things like going to an amusement park or a concert versus watching Netflix, going to a lake house for the weekend versus staying home, going out to dinner versus staying home. So the curb on out of the home activities will translate into a different and a less retail spend. So that's somewhat having to do with cicadas. I stay in because it is life is shining.
Really?
That is horrifying.
Where are you, Jill? Where is this happening?
I am home based in the Chicago market. They're pretty brutal.
Interesting.
Oh man, I didn't even think about the
So
cicada
we don't have
point.
cicadas here, do we?
No, we do.
We do?
Yeah.
I haven't seen
Yeah,
them.
no, I mean, like, not yet, but they're
coming?
definitely going to come. Yeah,
Okay,
yeah.
okay, all
But to your point about extreme temperatures, too, because then you stay home, and guess what? You pump the air conditioner, because if you don't, you're dealing with 100-degree heat, and that is a huge bill. I mean, already my electricity bill has jumped by two just for May, and it wasn't even that hot. So that's going to be another impact as well, yeah?
As well as think about the damage that comes from, a flood or hurricane, tornado. So yeah, it really drives dollars being spent elsewhere, as well as the fact that it curbs outside the home spending.
You talk about then in terms of how loyal people are to brands. Like, is it just going to be a pure value trade? Like the lowest price that you can give me is what I'm going to buy? Or do you feel like it's going to be very selective and brand loyalty matters?
So I heard somebody call this right now, and I thought it was pretty clever, that we're entering into the era of brand promiscuity, where we are essentially buying short-term loyalty, but we're really creating long-term disloyalty. So all those promotions buy today, but they sacrifice tomorrow. Having said that, I'd say that retailers are looking at a number of strategies. So it's not just promotions, it's their amping up their loyalty programs, their digital offers, their private label offerings. And let's talk a little bit about everyday price, right? So Walmart and Target publicly said that they plan to reduce the everyday price on thousands of items. This is a great trip driving strategy to get the consumer into their stores, especially the consumers that are struggling to buy the basics every day. And it's a real shift in what we've seen over the past 2 to 3 years. And it might mark the beginning of a price war, the likes of which we haven't seen since inflation took hold.
So what are retailers trying to do here? I mean, are they trying to keep customers? Are they just looking out for their own margins? What are retailers' strategy here?
Yes, and maybe a few more yeses. It is less today about a pie that's growing, and it's more about stealing share versus creating demand. So somebody's win is somebody's loss. Again, it could be a brand, a retailer, or a product choice. And so retailers, are trying to get purchases and consumers that they might not normally get and or have recently lost. One of the things that we're seeing now that's really interesting is both manufacturers and retailers trying to sell, call it non-traditional products and non-traditional outlets. And so you could expect to see health and beauty care products at a Dick's Sporting Good, maybe some more food products at a TJ Maxx. And so they're really trying to get new avenues of distribution to get those consumers in store. A flip version of that is if you look at the dollar channel has traditionally owned that lower price point or that opening price point, but so many other retailers are now entering into the smaller pack sizes for that opening price point and really getting that volume from the dollar stores.
Wow, that's really interesting. It's true. As a frequent user of TJ Maxx, I do notice that there is more packaged foods. The home goods store, oh my God, it's everywhere. Like half of it feels like it's food now. Just to wrap this conversation up as we go to sort of the Fed, let's just pretend the Fed cuts 1 or 2 times this year. They say 1, market says 2. Does that matter for the consumers that we are talking about? Does that materially change kind of what they buy and how they spend?
Long term, yes. Near in, not as much as we would think. It will have a little bit of an effect, but again, cumulative is really the word of the day here, and that it takes a while for any of these effects to catch up to the consumer. So what we're seeing today is the effect of what's been happening over the past 12 to 24 months. And so it will have an effect, but not as big of an effect near in.
Hey, Jill, thanks so much for joining us there. Really appreciate it. Jill Blanchard, President of Enterprise Client Solutions at Advantage Solutions, on Zoom from cicada-infested Illinois.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One other stock we're watching is Lennar, down by almost 3%. So this is a home builder, and it forecasted that deals in the third quarter missed consensus expectations. And then Barclays pointed out that if you take a look at their fourth quarter guidance, it implies a very large ramp up in gross margins in that quarter. And investors are a little skeptical as to whether or not that actually is going to happen. So no one to turn to but Drew Redding, Bloomberg Intelligence home builder analyst. He joins us now from Princeton, New Jersey. Hey, Drew, I don't know. I thought it was all like we don't have enough supply. This is bullish for builders. So what happened?
Well, I think you framed it perfectly. The story with Lennar and why the stock's down isn't so much about what's happening with the volumes. They delivered good orders. They're up 19%. They maintained their full year guidance for 80,000 home closings. It has to do with their outlook for gross margin. They guided to about 100 basis points below what the street was looking for. And as you mentioned, that would require a ramp in the fourth quarter to about 25%. So like you said, there's definitely some skepticism in their ability to meet their full year outlook. The reason for that is because we saw rates move up as high as 7.5% during the quarter. You know, they've come back in a little bit, but we're seeing their need to incentivize buyers remain elevated, and that's what's impacting profitability.
So where are we in that activity there? If I'm looking at a 7% mortgage, what are they going to do for me?
Yeah, so typically what we're seeing is that the builders will maintain a spread versus the headline rate. So if you're seeing 7.5% in the market, typically you're going to get 6% from a builder. There are some other builders, and depending on the market, depending on how strong the market is, what demand looks like, they could get you into the fives. But obviously that's going to cost them on the gross margin line. So the incentives they're using are certainly working. It's just what's the cost.
Mm-hmm. So that 100%, the 100 basis point miss, but then keeping their guidance for gross margin for the year, that must imply that they're looking for rate cuts.
Yeah, I think a lot of it has to do with what they're doing on the cost side. One of Lennar's emphasis for their business over the last several years has really been running a more efficient manufacturing-based business where they're not necessarily just chasing volume, but they're doing it the right way. They're fine-tuning their floor plans. They're pushing back on their suppliers. You have to remember they're one of the second largest builder in the country, but they're one of the only builders who has scale at the national level. So they're able to leverage that and kind of push back a little bit. So certainly some of the benefit that they expect in 4Q, I would assume, is going to come from what they're doing on the cost side, as well as fixed leverage from higher deliveries. But nonetheless, that's still going to be the focal point for investors, is how do they get there?
How much, I remember this back in the beginning of the pandemic, lumber went crazy. Mm-hmm. Where are we in lumber, and how is that a part of their gross margin?
Sure. So lumber is about 10% of the COGS for a builder. So it's certainly the most important input cost, as you would expect. Lumber prices have come back down a lot. So builders have been benefiting on the margin side. I think we've seen more stabilization of late, perhaps a little rise to the upside, but really lumber is not impacting the business in as significant a way as it was over the last couple of years.
So KB Home reports after the bell today, right? So what kind of company is KB Home versus Lennar, and how does that set up KB Home for today?
Sure. So KB is predominantly focused on the entry-level business. It's about 50% or more of their total sales. So in addition to just focus broadly on the entry level, we look at what they're doing from an ASP perspective to get a more holistic look. And they're actually one of the more affordably priced builders, particularly when you compare them to the resale market and against, their public peers. So I think from a pricing perspective, they're pretty well positioned. So they'll give us a good sense of what's happening on the lower end of the market. With that being said, as you would expect, entry-level buyers are much more price sensitive. They're more sensitive to that monthly payment and what's happening with rates. And we saw that earlier with a low-end builder, LGI Homes, who's looking to take buyers out of a rental situation and put them into a home. And we saw relative weakness there. I think what you see from some of the other builders is maybe a little bit more of a higher end entry-level buyer, maybe dual income, who's waited a little longer to purchase. So there still has been relative strength, but we'll get a good read on that buyer today.
What do the companies tell you about their expectations for interest rates, mortgage rates? What do they think is going to happen?
So I think the expectation broadly is that mortgage rates will start to come in a little bit as we get through the end of the year. I don't think they're managing their business for any, significant drop in rates back to, where we were previously. But I think as a builder, from a demand perspective, if we get rates coming back to the 6.5% range, that's pretty much a sweet spot for them. We've heard that as you get to 5.5%, that's really when demand in the market starts to move. So the fact that if we could get to 6.5, they're buying down rates 100 basis points, I think they'll continue to do well. And what's interesting is the public builders are kind of at the top of the food chain as it comes to housing. You have to realize they're generating about 50% market share compared to, call it, 38% prior to the pandemic.
Really?
Wow.
So they've really leveraged that lack of inventory in the resale market and the struggles among some of the smaller private peers, and they've capitalized on it.
So when you say the 5.5% is kind of a nice sweet spot, so that implies the Fed funds rate at 6.5% and the home builders still give that 100 basis point discount. When the Fed funds rate gets to 5.5%, do the builders still offer that 100 basis point discount?
I think it's going to depend on what the broader macroeconomic situation looks like. If we get a pullback in rates, a modest pullback, and we are still dealing with a pretty solid labor market, I think that, builders will be able to definitely pull back on their use of incentives. I don't know that they'll go away altogether, because at this point, it's something that buyers are looking to, and it's certainly made their product more attractive. If we get a significant pullback in rates, and it's because, the economic situation has deteriorated further, that's obviously more of a concern, and we would see them probably push incentives even harder.
What kind of homes are builders building these days, Drew? Is it the McMansion where they can get the big profit margin, or are they building what the market actually needs, which is some of these entry-level homes?
Yeah, that's a great question. And we've seen one of the primary ways that builders are addressing the affordability equation is through smaller square footage floor plans. It's a shift most of them have done. We've seen it over the last couple of years, more targeted towards the entry level. Interestingly enough, you even have someone like a Toll Brothers, who you traditionally think of as that luxury builder within the builder space. They've shifted to what they call affordable luxury. Now, it's still not something that the masses are going to be able to afford, but it's certainly a lower price point that, as I said before, is attracting those more well-heeled dual income buyers. So every builder has kind of attacked affordability in a different way, but I think square footage has been something consistent across the group.
We only have about 45 seconds left, but what's a builder that's kind of pulling on all levers correctly right now?
I think Lennar is actually an interesting case, and while the guidance may have disappointed a little bit, they're really delivering on what they said they're going to do. They're focused on price over pace, and they're willing to sacrifice a little bit of gross margin to do so. And the idea is that they're going to generate a ton of cash that they can use to pay down debt and return cash to shareholders, which is something investors obviously like.
All right. Hey, Drew, really appreciate it. Really great stuff. Drew Redding of Bloomberg Intelligence joining us on Lennar's earnings.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alex Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. So just head over to youtube.com and search for Bloomberg Podcasts. Let's turn our attention to healthcare. How about this? Japan is dealing with rising cases of a disease caused by a rare flesh-eating bacteria that can kill people within 48 hours. Health authorities have reported over 1,000 cases of streptococcal toxic syndrome. How about that as of early June? Higher than the record 941 cases reported for all of 2023. At the current rate of infection, experts fear the number of cases in Japan could reach 2,500 this year. For more on this story, we check out Amesh Adalja, senior scholar at the Center for Health Security at Johns Hopkins Bloomberg School of Public Health. Dr. Adalja, thanks so much for joining us. Can you tell us about streptococcal toxic shock? What is it?
Nice prono, by the way.
I know.
Nice
How
job.
about that? Tell us about it.
So this is Streptococcus is a bacteria that all of us have dealt with. It's the same bacteria that causes strep throat. What can happen, though, in certain individuals is it can be a much more severe infection where it can cause what we call necrotizing or flesh-eating type of skin infections, and then also spread systemically and cause multiple different organ systems to shut down. So that's when we use the kind of term toxic shock syndrome. It's that bacteria basically disseminates toxins throughout your whole body, and it's a very serious illness with high levels of morbidity and mortality.
Doctor, is this new, or has this always been the case?
It's always been the case. What's new is that in Japan, post-pandemic, they've reported at least 2 years where they've had higher than normal cases. And trying to unravel the mystery of why that change in epidemiology occurred is what's getting headlines right now. But streptococcal toxic shock syndrome has been around forever. It's just this increase in Japan that people are interested in.
How do the medical professionals, how are they treating this?
So the mainstay is going to be antibiotics, but because it's this systemic toxin disease, we often give other drugs to modulate the immune system. And if there are elements of flesh-eating disease going on, they basically have to do extensive surgery to kind of cut ahead of the infection.
Oh my God, this sounds terrible. How quickly does this happen? I mean, strep can come on really quickly, and it might take you a couple days to realize that you have it. Like, what's the cycle for this?
Well, when you get into that toxic shock syndrome spiral, it's very fast. It can be dramatic. Even an hour can be a major difference in a patient. Oh but it's important to remember that not everybody that gets a strep infection is going to get it. It's still rare. And most people who have a strep infection of their throat or of their skin, it's going to turn out to be kind of a garden variety infection. But it is important for clinicians to keep in mind that if people are getting worse, if they're not getting better, if there are more concerning systemic symptoms occurring, that they think about this. And it's also important for patients to know that as well, that if they're not getting better in the expected time, or they're taking a turn for the worse when they're already on antibiotics, that this is something where they need to seek care immediately.
Is there any reason why it would be, I guess, localized in Japan here? Anything that is unique to that part of the world?
Not particularly. I mean, we've seen increases in streptococcal infections, not necessarily toxic shock causing ones, all over the different countries. For example, the UK had a major issue with this a couple of years ago, and it may be having to do with kind of idiosyncrasies in the immunity in the population in Japan. Remember, we all came through a pandemic where there was a lot of social distancing, and many of the ordinary infections that people get every year were kind of disrupted. Mm-hmm. And there may have been different disruptions in different parts of the world and different prevalences of these infections. And now they're kind of coming back to their prior levels, and there's some catching up to do. There are people who might not have had as much immunity because they weren't exposed at a low level over the last couple of years, or they just might not have been infected. And there's a certain number that are going to be expected every year in Japan. And because you had a 2-year lull, now it's coming back to baseline levels, and that's what they're noticing. So this is kind of one of the leading hypotheses, but we don't know quite everything for sure what's going on in Japan. But that's what I think is at play.
What are the signs? You mentioned that if you're on antibiotics for strep and you don't get better, but you get worse, what are some other signs that people should be looking out for?
Well, so severe, a spreading rash that's getting severe pain if there's a rash where the infection might have been. Anything involving low blood pressure, extreme fatigue, not being clear mentally, difficulty breathing, all of those kind of signs that the infection is not localized.
Yikes.
Doctor, I remember we used to talk to you all the time during the pandemic. You were very kind to share your time and, kind of educate a lot of folks on what this virus was, how doctors and health professionals were treating it, and then ultimately the vaccine and the efficacy of the vaccine. So we, again, appreciate all that time you gave us. Now that we've got that in the rearview mirror here, I know one of the themes that came out of that was just the stress on the healthcare system and the people of the healthcare system, the doctors and nurses and everybody that worked, they had to be in the front lines during those early months and that year. How are the good folks at Johns Hopkins that you deal with in the facilities, how are they doing several years on now?
Well, I think that most healthcare systems around the country have kind of come to a new normal where there's kind of chronic burnout, there are chronic staffing issues where people quite haven't recovered from the way that the pandemic altered hospital operations. And this is going to be one of the long tails of the pandemic. It's not something that you can just bounce back from. There wasn't a lot of resiliency built into the system. There wasn't a lot of kind of slack in it. And the pandemic ate up all that slack. And I just think that we're in a situation where a lot of people still are carrying those scars around. of that time when they were overworked, where there were concerns about personal protective equipment, where hospitals were crashing. And even when you look at the economics of hospitals, we're seeing hospitals close, rural hospitals really looking at their financial viability, hospital bankruptcies. So this was something that took a major toll on the healthcare system, just like we expected and predicted it would. And this is why it's so important to incorporate healthcare preparedness, healthcare resiliency into planning for the next infectious disease emergency, whatever it might be. This can't just be something that we think about when there's a crisis, when it's in the headlines. This is something that needs to be done kind of with a long-term eye to the future, to make a sustainable way to operate hospitals and make emergency preparedness part of their core function.
How are we doing with COVID? I mean, COVID loves me. It doesn't love Paul, but it loves me. How are we doing with COVID? What are the cases like? Where are we going to get vaccinations in the fall for flu and COVID? What do you think?
Well, COVID is something that's increased over time in the last several weeks or so. But what we've seen is this virus is, endemic, but it continues to mutate and spin off new variants that are able to infect us. So right now, all across the country, COVID cases are up, emergency department visits are up, but its ability to cause severe disease, its ability to crush a hospital, severely constrained because of the immunity and the other tools that we have. We will have new vaccines in the fall that are better targeted to what's circulating, and that will likely be something that's recommended to high-risk individuals that they get right alongside their flu vaccine.
All right, Dr. Adalja, thank you so much. We appreciate that as always. Dr. Amesh Adalja, Senior Scholar at the Center for Health Security at Johns Hopkins Bloomberg School of Public Health. And again, the good folks at Johns Hopkins were so good to us, during those early days when we didn't know anything.
Nothing. I actually want to say we should get him back when there's not a crisis, just to learn about stuff that isn't a flesh-eating disease.
Right.
That comes from strep or COVID spreading again, just to learn about the system and what cool things are in the pipeline to be discovered and what people are treating. And I mean, everyone's living longer, right? We're letting people live longer, but then how we support them really fails. And getting that dynamic from him would be super interesting.
Yep. I went into a healthcare facility for the first time yesterday, and I can't remember how long, for some x-rays. I mean, what I was interested to see, how well it was staffed. Are there nursing shortages? Are there technician shortages? And it seemed like it was back to normal. There's plenty of folks there. A few masks here and there from some of the healthcare professionals, but it seemed like pre-pandemic business as usual. But again, as Dr. Adalja was saying, there's some long tail issues for the industry as a whole, I guess. They were so crushed. I think about the hospitals here in New York City that were just so crushed.
You should just see the ERs are crazy. They're just overflowing. It can take days to get a bed, and it's just it's the healthcare system is in real issues with that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance live from an Interactive Broker studio right here in Midtown Manhattan. Now, for the month of June, Bloomberg Radio is committed to bringing you segments and guests focused on the topic of equality. And today we have the pleasure of speaking with Olaolu Aganga. She's U.S. Chief Investment Officer over at Mercer. She is a rock star in her own right as an investment analyst and portfolio diversifier and talk about clients and all those things. And also, she is in the C-suite and also working mom, and that's hard. So we can cover both. So can you just tell me a little bit about, your career and how you got to where you were?
Well, thank you for having me. I heard the introduction too kind. I just started laughing because my daughter would just be like, "That's just mom."
Yeah, totally. I can appreciate that.
that is what happens. So, there are days that I take a step back and I look at my career and I'm even blown away and surprised. Frankly, I've had the privilege of being in the U.S. I moved here for college. I'm originally from Nigeria. My family's from Nigeria, born, raised both in Nigeria and Botswana. And I moved in 1999. I studied math, didn't know what I was going to do with it. It was somewhat accidental. I was trying to find a place that gave work visas.
Yep. So that's a big. It's got to be a big firm.
It's got to be a big firm.
Right.
And my family's science-based. I ended up working at a bank because they're big hires and they gave visas back in the day. And it was a trading desk. And all I could think of was I needed to work really hard to keep this visa. And I learned about markets. I learned about trading. I realized that in order to stay here, I had to, in my head, work harder than everybody else and just show that I truly wanted it. And I was a student of markets. I just loved learning. And over time, I was fortunate that folks saw me and gave me a chance and opportunity to do more. I raised my hand and I asked for more. And, fast forward, I don't know, 20-something years or more, I'm the chief investment officer at one of the most major prominent platforms for endowments, foundations, healthcare, pensions. Like the assets and the responsibility that we have blows me away, and I take it very seriously. And I'm just truly grateful to be in the seat.
Women in financial services on Wall Street, a constant challenge. And in my prior role, I hired a lot of folks coming out of school, and our entering classes were perfectly diverse. Perfectly diverse. 10 years later, when it came time for the managing director or partner discussion, not so much.
Yep.
So what was your experience going through this whole process, having spent that much time in the business?
I knew that I had to not think about it. It was a deliberate choice to not think about it, because if I did, and you look at the numbers, like, it's very easy to be discouraged. It's very easy to say, I don't see it, so how can I think it and be it? And make no mistake, I did think it very often, but I just had to actively put it out of my mind. And there are certain points that you have as a woman, your choice of a partner, your choice of having a family, and when you do that, how much time you spend with. I have a daughter, she's turning 5 in a few weeks. There are points that you will be slower in your career as a result of that. It's also a choice, and there are times that you have the ability to do it. For me, I found that it's been support and the support system around me.
And you mean like personal or job-wise, or both?
Both.
Yeah.
Definitely both. If the job-wise was like, you can do this job, and personally it's hard, you have to make that choice. A lot of women are like, I will choose, and it won't be you. It won't be you job. It will be the family, because that's, at the end of the day, when we leave this world, that's what matters the most. So when put in a situation where you have to choose, and many people are in situations whereby they have to choose, they don't choose work. So how you have the support in place to be able to have both, which you can't have them at the same time, at the same intensity. Yep. You can have it, but you have to stage it. Like I said, my daughter's 5, or going to be 5. So I had children later in life in order to be able to go as fast as I could without making some of those other trade-offs. And then having the support system in place while you are doing the work.
So I love that you brought up support. I had a dinner last week with a bunch of women in finance, super successful, really great. And eventually it turned to the topic of they couldn't do those jobs, and neither could I, without a really supportive partner. And that you learn really fast, particularly when you have kids, how supportive that partner is actually going to be, particularly when you travel. But that's hard. Like, that's not a given, particularly if you're a woman with like a career-driven role and you put that first. That's not a given in the world. Not a given.
Not a given at all. And in life and in work, there is your ability to work hard, your intelligence, and then there is luck. And I will admit that there's a lot of luck that I've had. My husband I've known since I was 18.
Oh my goodness.
So we grew up together, essentially. It was, okay, you go to school, you're working, you're
It was like a trade-off.
It was trade-offs, and who's on, who's off, how do we do it? And who knew, the stats in this country are not necessarily encouraging in that respect, but we communicate a lot and we have honest conversations. Who's on, who's off, who picks up the gap, and for how long.
Oh, that's interesting.
I think what we learned, just real quickly, 30 seconds, the child care and now the elder care in this country, boy, that's got to change. We learned that, I think, during the pandemic. People who weren't aware of it they became aware of it pretty quickly.
Yes, absolutely. And the pandemic was a big equalizer for many families, like men and women, whatever it was. Like everyone had to pitch up and roll up their sleeves. You could have a nanny, but could they come in?
Nope.
Right? So that was it. And then you had that, plus if you had elderly parents, which my parents are not in this country, my husband had at the time, and how you're navigating that on both sides. You get pulled, frankly, to be able to do that. During the pandemic, it was everybody was experiencing that. But if you remove the pandemic in quote unquote normal times, it's hard to be able to have that empathy in place with people that are managing a number of other personal commitments.
I could talk to you for days. So definitely come back. We can do a little bit of this. We can talk about your market views. Really amazing. Thank you so much for sharing. You're speaking a lot of what I hear about all the time and things that I go through too. So thank you for sharing that. Lalu Aganga, she is U.S. Chief Investment Officer over at Mercer.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.